Hey, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Kenny Wolfe. Kenny is an experienced multifamily syndicator, the founder and CEO of Wolfe Investments. He also a published author with Investing in the Dream, How to Acquire Multifamily Real Estate and Attain Total Financial Freedom. So, Kenny, welcome to the show.
Thank you for having me on, Eric. Appreciate it.
Yeah. So tell us about kind of like your how you got started. I mean, I don't. How did you get started in multifamily right away, or did you do some other kind of like intermediate step before you did the big jump?
Sure. That's a good question. I actually started in oil and gas. I
Oh,
was on the accounting side. So at the ripe old age of 28, they made me CFO of that company. And we grew it pretty big and had a good run. And then we were winding that company down and just decided I wanted to be out of oil and gas because that
yeah.
has huge ups and downs, feast or famine there in that industry. So wanted to go into real estate, always had a passion for it. But actually, I did. I ended up jumping right into multifamily. So I've actually never owned a single family rental myself.
Hmm.
Jumped right into that. I was passive twice to kind of learn the ropes because I knew I didn't know what the heck I was doing.
Yeah.
One was a huge fixer upper. The pizza delivery guy wouldn't go into the complex because he'd get mugged.
Yeah.
It was that bad. And then the other was a yield play. Yeah, the other was
Wow.
a yield play, Fannie Mae loan. And so kind of, specifically chose those two because one, to see just complete polar opposites of investing in multifamily. And then also to build the team too, because I need to know who's the management company, who's the mortgage broker, the roofer, all these things that you need to know. And then after that one, I syndicated a 76 unit deal, found I think 11 people besides myself to throw some money in, and we bought a 76 unit property in Wiley, Texas, and it just kind of snowballed from there. Uh,
Hmm.
so that was kind of how it all started.
Yeah. Wow. Yeah. Yeah, a lot of people also start kind of like being passives, right? So they kind of like put some money in and they either like a joint venture or they join a syndication. Um, what's the best way to leverage that? Because I think a lot of people, they just, I mean, you learn a little bit, I would think, but you're missing a lot also by just being passive. I think it's you're more complacent for one thing, and instead of when you're in the driver's seat, you are on the hook for everything.
Right.
And as a passive investor, it's pretty easy to, oh yeah, I want to be involved, and then go away for 3 weeks, and then are done. You know what I mean?
Right. Yeah. No, you have to be committed to that. So when I was, I was 28 years old at the same time too. I was writing $100,000 check to be a passive investor. My hand was shaking.
Yeah.
Because a lot of money, especially to a 28-year-old to write. But anyways,
Yeah.
put it in. I said, like, this is my investment. It's also my education. So
Yeah.
I'm going to be asking a lot of questions. I'm going to dive into the numbers. Whenever you're on site, I would love to come tag along. And so I was that guy who just really kind of stuck with it, and I was not complacent. If you're going to learn, like you said, you cannot be complacent. You're not. It's not osmosis. You
Yeah.
actually got to go walk the property if you can. Dive into the numbers, ask questions, and figure out who the teammates are to help you run it. If you want to be a syndicator, not everybody wants to. Not everybody's cut out to be a
Yeah.
syndicator because it's a lot of hours.
Yeah.
It's not passive at all.
Yeah.
That's the
Oh,
opposite.
for sure.
So that's it too. Is like you gotta, you as an individual have to know like what's your end game. Like, do you want to end up being a syndicator or do you want to be on the beach and collect checks? I mean, those are two different roles, and the both are fine, but you just got to know what you want.
Yeah, yeah, yeah. And so what's your strategy when you are looking for an investment? Let's just say like multifamily, but I think some of it is also applies to other types of investment. How do you decide? Do you look at market first? Do you look at the deals first? What's the strategy there?
Sure. Yeah. So we have three arms of the company, but for multifamily, we have to make sure that it's a landlord friendly state. If we can't evict someone who's not paying us in 9 months, then I have to pay my mortgage for 9 months.
Yeah,
I'm not investing in there. I want to stack the chips in our favor. so that's the A number one. And then within that state, then we dial into which cities we want to be in. So, I always pick on Midland, Odessa, Texas. We love Texas. Great landlord friendly state, great business friendly state. But Midland, Odessa is all oil and gas jobs. And so if you invest in multifamily in Midland, Odessa, you're really in the oil and gas business.
Yeah.
Because your rents and operations are going to be directly tied to the price of oil.
Yeah.
So we want diversified economic drivers as well in that
Business
city.
diversification. Yeah.
Yeah, and then population growth, rent growth. Like it's not rocket science what we do.
Yeah. So your criteria are actually pretty similar to the ones that I use, for my investment. Yeah.
Yeah, it's not rocket science. Now, so we have a triple net arm where we go by CVS, Dollar Generals, and all those. We're in 15 different states. We own properties in New York State. I would never own a multifamily in New York, the state of New York, but we have multiple Dollar Generals and CVSs up there.
So for our viewers out there, can you explain kind of like what's a triple net kind of investment? What does that look like, and how does it compare to a regular multifamily kind of apartment?
Sure. And we still buy multifamily today, but we added this about 5 years ago, this arm, because some of our investors wanted like just a monthly stable cash flow coming into their bank, their ACH or check, whatever they want. And so multifamily is operational heavy, right? We have to go chase rent. We have to fix toilets, right? And so we do quarterly distributions on our multifamily because 1 month we'll have higher rents or higher revenue, lower revenue, higher. So it smooths it out if you do quarterly on those. But for these triple net and double net properties that we buy, we buy them underneath a fund. So we're on our fourth fund now. So one investor comes in, they own this current fund. It's got 14 stores in it today and another 10 coming here in the next 60 days. But so they have their ownership is spread over multiple stores, which is nice to de-risk it somewhat because they're all we buy our high credit. Most so far it's been all single tenant stores. So it's like buying a single family home. If you're vacant, you're 100% vacant. So the riskiest part in investing in single family rentals is this: when you only own one.
Yeah, exactly.
You need 2 or 3 to smooth out any vacancy, right? So it's the same thing. So that's why we buy these under a fund. But basically, our credits our tenants are CVS, Walgreens, Dollar General. But so a true triple net lease is where you're the landlord, you own the land and the building. And then the tenant takes care of all the operational repairs and maintenance on the property. They reimburse you for property taxes. They reimburse you for insurance. So it strips out all the operational risk, almost all the operational risk compared to multifamily, and which is nice. And the blessing and the curse with those is that you have long-term leases. So you've got 7 years left on a 15-year lease with CVS at that location. So you're going to get paid rent. The problem though, the curse is that in multifamily, our leases reset every 12 months. So you can raise that rent. Well, so with these, you're locked in your rent. So that's the blessing and the curse, right? So anyway, so that's some of them are double net, and so triple net gets used way too much. Double net is mostly what we actually see in the marketplace. Kind of worst case for us is always our family dollars that we own. So worst case that we're on the hook for the roof, the structure, the parking lot, and part of the HVAC. So other than that, they take care of everything else. They still reimburse us for property taxes and insurance. So it's still a lot less operational heavy. And just great, monthly cash flow rolling in every single month.
Yeah, but as long as you have the finished what's not driveway but parking lot, and the roof is fine, and the HVAC is and you pay the maintenance if there's any maintenance that needs to be done, then you're fine. The rest of the operations for the building is being covered by the tenant.
Exactly. So they're great. We like those. We had folks that just wanted that monthly cash flow just so they can drive around their RV and still have that ACH hit every single month, and that was a great fit for them.
So and any particular states that are especially good for the triple net kind of I know you mentioned that you're investing in like 15 states right now for that, I think. So any particular states that we should be looking at if someone is interested in that?
I mean, you want to see population growth. I mean, you don't really care about landlord friendly because that no one's trying to cancel their rent.
Yeah.
But no one's trying to cancel Dollar General's rent. But so we're, on that front, we don't really care. But you do want to know population growth and then traffic counts
Mhm.
count a lot more, because if you do have to replace that tenant, traffic counts have to be high enough where you're going to get, if it's a Dollar Tree, you can replace them with a Dollar General or Advanced Auto Parts, or you
Yeah,
can
yeah,
make
yeah.
cash folks. So traffic counts count way more in that than multifamily.
Okay. And do you find the tenant for like you mentioned like Dollar General and stuff like that. Do you find that tenant, do you start to build a relationship with some of these key tenants, and then you understand kind of their needs, you understand like Dollar General, they look for specific areas. They're now there's some areas that you're not going to find at Dollar General,
Right.
but other areas are more prone to that. And then you kind of go and seek out the space for a potential location for them, or which
Sure.
comes first, the tenant or the or the
Uh,
property?
that's a good question. So our funds actually buy only existing occupied buildings.
Okay.
And so we're walking into, cash flow day one. We haven't done that yet. We've actually just became a Take 5 auto or Take 5 oil change a developer.
Okay.
So we're going to see if that works. We haven't got one yet, but we'll see. So that we're maybe growing into that
Yeah.
potentially in the future.
Okay, so you buy things that are currently occupied by an anchor tenant, and then okay, so you build from that. So the are you doing any kind of like office building or any kind of office building conversion or anything like that as well as part of that, or you're really focused on the retail?
No, so yeah, so that's our third arm. So we do ground up multifamily, and then 2 years ago fell into buying downtown office high rises and converting them to multifamily. So that's our development arm. So we've
Okay.
got 9 of those now across the U.S. 9 office towers we're converting.
Oh
Um,
wow.
so those are great. Some of them are historical buildings, so we get some grant money from there. Some of them are opportunity zones. So uh, those are pretty cool, but for a different reason. They're not great for cash flow. Obviously, it's
Yeah.
development, but they are good for huge gains quickly.
Yeah. Mhm. Yeah, as long as you're in the right area and you have to do like significant either ground up development or I think it was like more than 50% of the value of the property, right?
Right. Yeah. Yeah.
That
Yeah. These are not light rehabs.
no, this is massive rehab that you have.
Massive. Yeah. Yeah. Repurposing those buildings are great. So we have I'm flying up here in a few weeks to check it out, but we have 3 stories torn out of the old Ohio Bell headquarters in downtown Cleveland. It's 500,000 square foot building that
Yeah.
we're converting to mostly multifamily. We'll have some retail restaurant in the bottom floors
Okay.
too.
Okay. Interesting. So, what are some of the kind of like the I would say like aha moments of your career when you're looking at like all the stuff that you've done? I mean, you've done like from single family all the way to commercial, triple net, multifamily, and stuff like that. What are some of your aha moments?
Going into it, our my biggest kind of, I don't know, rule I kind of stuck to was I can't be bogged down in the day-to-day operations.
Hmm.
And so that really forced me to, our first syndication was 76 units. I went past it twice and then went into 76 units. And
Yeah.
the reason why I wanted that big of a property is because I didn't want to be the one collecting rent or evicting or changing toilets, like that kind of stuff. If you're into those smaller properties, you're going to be dragged into the day-to-day operations, and you can't grow your portfolio.
Yeah.
So that was the biggest thing, and that was a big rule of mine starting, and it turned out to be pretty correct, because
Yeah.
that 76 unit deal we bought was actually a portfolio. So there was another guy that bought the 32 units.
Mhm.
And so that guy, the seller wouldn't sell me my 76 unit until the 32 unit closed. So
Okay.
he didn't want to be stuck with a 32 unit deal.
Yeah.
So there's
Yeah.
a lesson there. But the 76 units, that allowed me to have full-time manager on site, full-time maintenance on site.
Yeah.
And so we've done over 8,000 units. I still don't know how to evict anybody.
Yeah.
We've
Yeah.
got great people, on site that do that, and make these units ready and upgrade them and all those things. But if I were doing that, I couldn't have grown the portfolio
Yeah.
as big as we've done it.
Yeah,
So
exactly. I mean, people are kind of like they're always complaining about, oh, I have to pay property management and stuff like that, and it's not worth it. But it's been, even on single family, people get started and say, oh, I'd rather do the property management myself. I was like, what, you're gonna say like $100? Imagine
right,
you're hiring someone $100 a month to take care of anything that could happen during the month. You
right.
like,
What's your time worth?
cheap.
That
This is
yeah.
cheap. And
Right.
it's paid by the tenant anyway. So it's like,
Yeah, exactly.
what are you worried about? And then you can focus on, other things, like focus on, hey, we're buying the next one, and
Right.
all that kind of stuff.
And that's where you make your money is
Yeah.
by growing your portfolio. It's not changing the toilets or evicting someone or
Yeah.
leasing a unit.
Yeah. Yeah. So kind of like what's the any other aha moments or kind of lessons learned from your career?
Um, Man, I mean, there's a lot. We've learned a lot. We've grown a lot. I think diversification is a big deal too. We were one of the first. So we're in the syndicator crowd here in Dallas Fort Worth, which is a very crowded field. I
Yeah.
think Texas is the hotbed for that. But
Mhm.
we were one of the first ones to step outside of Texas. So we had an investor group here. We bought a 192 unit property in Colorado Springs.
Okay.
And by branching out to different states and different cities, our deal flow was just that much more. And
Mhm.
so, because I felt the Dallas Fort Worth prices were high,
Yeah.
I didn't. To me, there was a lot of risk there, and so
Yeah.
going to these other markets, really, it just fueled our growth, but also made it, it just diversified geographically for our investors. Better options. They had more options to choose from.
Yeah. So what would you consider is kind of like your secret sauce or your secret value process or stuff like that you do that some of the other investors out there are not doing?
Sure. I mean, everybody's looking for value add. Everybody's got that same, everybody wants the B minus to a B plus value add. That's the thing that everybody wants. So how do you set yourself apart in that? And so we get off market deals now, and I know a lot of people say that, and they still come from brokers in the multifamily world.
Yeah.
But I mean, we're buying two right now where they were sent to us off market, and we got first dibs because they know that we close on time. We say what
Mhm.
we do, and we do what we say, and we don't retrade unless it's just something horrible that the seller's hiding.
Yeah.
But we don't retrade, and because that quickly gets you a bad name in the industry, and people don't sell to you.
Yeah.
So we get a lot of first shots like that, and then really just kind of thinking out of the box on creating value. So like these office conversions,
Yeah.
we get historical grant money of 20% of our construction budget. We've got,
Mhm.
and then some of them don't come with parking, and so
Yeah.
we actually have, we're on our second property now, Sonder, which is a luxury Airbnb rental company, now publicly traded. They're actually going to rent, but we've got a property we're buying now in Dallas. No parking comes with it, but they're gonna rent floors 2 through 18 on a 10-year lease at $325 a foot.
Wow. Wow.
And so
A lot
before
of
we even swing
floors.
it, yeah, exactly. It's 18 floors, so they're taking the whole building.
Wow.
And the bottom floor is already 7-Eleven, restaurant, and a
Makes
high-end salon. But like that building, before we even swing a hammer, we're 98% leased. I mean, it's
That's
it's those
amazing.
kind of things we keep trying
Yeah.
to find value in for our investors.
Yeah. Wow, that's crazy. So yeah, and yeah, that office conversion is it's pretty interesting. I mean, this is fairly like I haven't heard that too much. Any particular areas that are very like kind of like ready for that kind of business?
Oh man,
That kind of
that's all
conversion.
over. Yeah, it's really
Oh,
all over. Although zoning is a problem if you're in
yeah.
some states. The states that we're in, we don't have to do any rezoning.
Mhm.
It's all just commercial, and we look for downtown locations because we want a property with like a 95 walk score when we first buy it, and then we know we're only going to make it even better.
Mhm.
So we focus on the downtown core assets like that. The zoning, watch out for that on some of the states, like trying to get something rezoned, and Manhattan's probably a nightmare.
Yeah,
But in
probably.
downtown Cleveland, you just get, like you automatically get
Yeah,
it. You just got to get a
like
checkbox that
yeah, like San
knows you're doing.
Francisco or something like that. It was like
Yeah, maybe tough. So I mean, you want to, in development, early on when I was talking to a developer when I was first starting, I said, what's the lessons, that you did?
yeah,
Because he was a developer for 30 years. And he said, don't fight City Hall, so
okay,
I just took that to heart. If it's not zoned what I want to develop, then I don't mess with it. So that's somebody
yeah,
else's
yeah,
problem.
exactly.
So
This is going to
um,
add a year to your project, just changing the.
yeah, and why yeah, there's plenty of office spaces, and so before COVID, most major downtown or most major cities in the U.S. had a 30% vacancy on office before
Mhm.
COVID. So we
Yeah,
had too much office before COVID.
yeah,
COVID comes now. I don't think I think we're much more efficient at our office when people are in the office. So
yeah,
people are coming back to the office, but our neighbors, they're an IT company.
yeah,
They don't need to come to the office. So there's
yeah,
some industries that won't. So we'll have a paring of that down, obviously.
yeah,
Uh, so it's really those office towers that are vacant, that where these office owners are hurting,
yeah.
where we're finding a lot of folks come to us.
Yeah, and I know that some areas I think there was overbuilt in terms of office. I know that in the San Francisco Bay Area where I used to live, I mean they were building office buildings like crazy. There was no place for people to live, but
Yeah.
unless you had a couple of millions to throw at it.
Right.
But it was crazy, and they were building more and more office towers, and then everybody's like, well, who's gonna move in there, like.
Right.
And
Yeah.
now and that was just before the pandemic. Then the pandemic hit, and like then everybody would say, well, you can work from home, you can work from lake top from your cottage, and people
Right.
moved everywhere. A lot of them are
Right.
in high tech, as you know. So is that so these office towers might be a good idea to convert them into apartment building.
Right.
So that could work out pretty well. Is this a different zoning? Like if you have an office building and apartment building, is this a completely different zoning? One of them is more kind of like multi-residential or?
It depends on the city and the state you're doing business in. I mean, on we've got two assets in downtown Atlanta, two in Cleveland, one soon to be in Columbus, Ohio, and a couple here in Dallas, Fort Worth. So all those cities where we're doing business in, we don't have to rezone it. It's all zone commercial,
Okay.
and so we don't have to fight. You don't have to do any kind of rezoning. Some cities absolutely, and we haven't messed with any of those. So.
Okay. But if it's zone commercial, then you can do either like a office building, you can do retail, you could do apartment buildings.
Right. Well, so, but I want to put an asterisk. Not all cities do that, but yes, on the cities that we're in, yes, absolutely.
Oh, okay. Well, this is very good. So thank you for all that information. So let's talk about so people, our listeners, right now they say, well, this is pretty interesting. This guy has done a lot, has a lot of experience in all kinds of different kind of real estate investment. What's the recommendation for someone who wants to get started? How do they get started? What space would you recommend they get started in? And kind of like, yeah, how to help them decide which strategy to use?
Sure. I mean, I always tell folks to start with the end in mind. So again, do you want to be an active or a passive? A passive, I mean, that's pretty easy. You just need to go network and find people. We co-host a multifamily conference that's just education and networking, no guru thing to buy at the end.
Mhm.
We've got our next one coming in Atlanta here in November 12th, but we do that 3 times a year around the US. But so those are great. We meet a lot of passives there. And then also a lot of syndicators go to that event too, because or people that want to be a syndicator. So for those that want to be more an active role, I think being a passive first and being what I call an active passive, someone who actually digs in, wants to walk the units, wants to be there, is on reads the monthly or quarterly financials, whatever your folks send you. But someone like that, because you're going to learn a lot that way.
Mhm.
And then really, again, it's networking, because if you're going to be a syndicator, one, you got to go find good offerings, good investments, but two, you got to be able to raise money.
Yeah.
And you only do that through networking. And so you've got to put
Yeah.
yourself out there. shake a lot of hands, drink a lot of coffee at Starbucks. It's really that's the path to get going on that.
Yeah. Yeah. And networking is key. Absolutely. I think you learn a lot. I mean, this is one of the reasons why it's like I like Breakaway with my podcast, because I get to interact and network with a lot of very experienced investors, and I always learn a lot from what they've done, the work that they've done, and so speaking with you is also great from that perspective, learning about the office conversion, learning more about the triple net and what you're doing. So this would be this would be a good example of why networking is so important, but also for money. I mean, you understand more the business because you're talking to other people. Real estate investors is a great community to be a part of because everybody's sharing their information, they're sharing strategies, they're sharing all kinds of very good information.
Right.
And for money as well, to be able to get some investors partnership going in case you get into an opportunity that is great. Sometimes some opportunities are too big for you.
Sure. Yeah.
And then you say, oh shoot, I mean, I'm gonna call Kenny. I've never done this office conversion, but I think this is the perfect deal.
Right.
I know the perfect guy for that, and then I call you, and so that's
we just actually had that. I had a call this morning. There's a group out of Chicago. They've got some old warehouses, a great location in downtown Milwaukee. Anyways, they contacted the lender. They said, well, we're bringing Kenny. So actually I'm teaming up with them now on that downtown Milwaukee project. So yeah, it's a team sport,
Exactly.
There's a way we can all kind of work together and make money.
Exactly.
Real estate.
That's what I love about it, is about this community, is that it's very collaborative. And,
right.
So I really appreciate that. And so that's why I'm telling my listeners, the first thing you need to do, and you continue to do, and you always do, is networking.
Right.
Really, and sometimes it's not about selling. It's really about networking, understanding what the other person is doing, telling them what you're trying to do.
Yeah.
If they have any kind of insights into that, and then working that way. Eventually, if you find that opportunity, that nugget that you want to share with other people, then all that networking is going to pay off.
Absolutely. Yeah. And if there's a hole you're missing, like if you don't have the net worth to guarantee a loan, or the cash flow, or the experience, there's a way to plug in any of those holes. You have to add some value. Yeah. But if you're missing something, which everybody is, especially when they're starting out, you've got to team up. And you can't do that without networking, like you said.
Yeah. So Kenny, if people want to reach out to you, they want to buy your book, they want to be part of your conference and stuff like that, where can they reach out to you?
Sure. Yeah. So the best place to reach out to us is our website. So Wolfe with an E-investments.com. On there, we put out a lot of educational content on our YouTube channel as well. So just type in Kenny Wolfe, it'll pop up. And then the book is on Amazon. So I'm working on, we're hopefully releasing my second book in December, but we're working on that now.
Okay. Wow. What's the second book about?
The second one's more focused on kind of a broader range of personal finance. So it's a way to go from zero to generational wealth.
Okay, great. Yeah, that sounds good. Yeah, a lot of people need that, especially as we heading into a weird economy.
Yeah, exactly.
Well, Kenny, thank you for sharing your knowledge and experience. And so make sure you like and subscribe. Because we're going to be talking to more and more of these very fantastic guests in the future. Every week there's a new guest that we are interviewing. So make sure you like and subscribe.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.